Hi, I'm Joshua Freedman, news editor at Rapaport, and welcome to the Rapaport Market Comment, thanks to our sponsor Rapnet. Signet Jewelers announced the results for the fiscal third quarter on Tuesday. There were no big surprises. Sales fell 12% year on year for the 3-month period that ended October 28th. This reflected the impact of inflation on consumer spending as well as an expected lull in engagements. Signet is the US's largest diamond retailer, owning store chains including Kay Jewelers, Zales, and Jared. So its results are among the best indicators we have for the state of America's diamond and engagement market. Signet CEO Virginia Drosos and Chief Financial Strategy and Services Officer Joan Hilson addressed investors in a conference call after the data release. Here are the 3 main takeaways from what the executives said. Number 1, engagement ring demand is recovering as expected. Signet believes the recent slowdown has partly been because of a drop in dating during the COVID-19 pandemic that resulted in a lull in proposals this year. But Drosos also said Google searches for engagement rings are up 10% compared with a year ago. In its market research, the company tracks 45 different relationship milestones to know how close America's couples are to an engagement. It says couples have been gradually moving through those milestones and more are choosing to get engaged. Its sales of engagement rings began to rebound in recent weeks, ahead of the holidays, and the company expects a gradual improvement in 2024 and over the next 3 years. Number 2, Signet believes it has handled the downturn well. Drosos said independent jewelers had too much inventory and reacted by being very promotional. She believes this contributed to the decline in global prices of larger diamonds, referring to stones over about a third of the carat. In contrast, she said, Signet has managed to maintain its average transaction value during this time. It also used its market research insights to predict the bridal slowdown and reduce its inventory accordingly. However, the market is getting better now. According to Drosos, independent jewelers have been buying less in recent months and their inventories have dropped since the first quarter. And as we said on this video last week, miners have reduced supply, diamond manufacturers have lowered their inventory levels, and polish prices have started to stabilize. Drosos noted these facts and predicted that the natural diamond market would likely normalize during 2024. Number 3, Signet acknowledged that the price at which it buys lab-grown diamonds has come down considerably this year. Drosos thinks these rates have fallen to the cost of production plus a small margin, so she doubts they'll fall any further. Both executives on the call said Signet had managed to maintain average transaction values for lab-grown through branding and special diamond cuts, boosting its margins. Furthermore, Drosos said the lab-grown segment grew much faster earlier in the year, but has leveled out in the last couple of months. Signet declined to expand on that when I asked. The company was relatively confident the holidays would meet its muted expectations given the state of US consumer demand. Its share price rose almost 6% on the day of the results, suggesting that investors think the same way. If you like this video, please subscribe to get every new one we make on a weekly basis discussing trends and analysis in the diamond industry. This video is brought to you by Rapnet, the world's largest and most trusted diamond trading network. If you buy and sell diamonds, Rapnet is the right solution for you. Find out more at rapnet.com. Wishing everyone a happy and peaceful week ahead.